Good morning. This is Jeff Scott. It's Sunday, March 28th, 2021. Holiday season, Passover for the Jews. So Seder 1 and Seder 2. And Easter coming up, short trading week with Friday closed because of Good Friday. So a little bit easier this week, perhaps. I titled this week, Does Friday's strong close mean it's time for bulls to go back on offense? Notice there is a question mark there. It's as much a question as it could be perceived as a statement. My email address is hgsidoc@gmail.com. If you are watching this on YouTube, please go to the bottom and click on the up or down thumbs. Obviously, I'd prefer an up. It would be nice to have more people watch this, considering the amount of work I put into this. And the only way that's going to happen, since I'm not a marketer or advertiser, is if people like it. So hit the arrows. And then remarks are always welcome, and they can be in YouTube or directly to my email address. As always, it's for educational purposes only. Anything I say is in the spirit of education, should not be considered investment advice. I'm a doctor, not a broker. I am independent. By that I mean nobody pays me to say good or bad things about anybody or any tools. The tools that I used, I paid for. And trading involves risk, and you are solely responsible for any investment decisions you make. I used to do some live education, got too busy with work and with COVID, so that hasn't happened. But I'd always tell folks, be your own guru. And by that I meant find smart people, some of which that I found are here, learn from them, and then become your own trader. What works for them may or may not work for you. You create your own brand. You can combine different styles to come up with your style. Calling out some of the keys, O'Neill with CanSlim, Ian Woodward, the late George Lee. All very important in getting to me where I'm at. John Person, Sagar, great tools, great stuff as well. I own a lot of software. I hope I remember to kill my desktop. If not, you'll be able to see how much I own. But what I really use is TradeStation and Thinkorswim with various indicator sets, some which are listed here, HGSI and EdgeRater. Now, I also do a lot of websites that I play with. I'm looking at unusual options and stock activity and other things, trying to see if it can give me an additional edge. Another thing I look at for an edge is seasonality. I'm never paid by any vendor. When you buy something that I suggest or use, and any affiliate fee which they might offer is passed to you as a discount. Now, an affiliate fee is simple. When you go on a webinar, let's say Service A you're a member of, and they send you out an email, hey, my good friend Service B is going to do a webinar for my users. Typically what happens is Service B offers a discount to the members of Service A, so you get something out of it, but they also have a bit of a give back fee paid to the referral, to the one that you're a member of every time somebody buys something. I don't do that. I'm an unpaid volunteer, and this is just education. Staying in the, I don't get paid if you do this, but here's the website for HGSI, highgrowthstock.com. Notice my email address, one of them is highgrowthstock.doc, unaffiliated. My account is where you find the downloads, free 30-day trial. No credit card required, and under investing strategies, you'll see thousands of videos. Where are we on this pattern? Feels like we rolled over. Problem is, depends who. If you are the spiders, hit an all-time high this week. All-time closing high, I believe, was Friday. If you are the Dow, all-time closing high, new high. So clearly going up again. If you're the Russell, you struggled and you got right back to the 50, but at best you're midline, but you've turned down. And if you're the Qs, you're struggling under the 50. So this is a market of markets, and they're not all the same. If you weren't watching, and we'll talk more about the last 30 minutes, but wowsy, did that market change on a dime? We'll see if there's any follow through. The stocks that I buy, high growth stocks. Now, when I say high growth stocks, these are stocks with earnings per share growth, high relative strength. Sometimes they're IPOs with just high relative strength and nice chart patterns. You know, last year I made 300% returns, or between 200 and 300. I can't remember what the final number was. This year, not so much. I got as high as 60%, and now I'm probably closer to 40, 45% after the market rolled over. Still a pretty good year, and it's only March 28th, right? So I still got time to get to triple digits. Much tougher year. The reason why I get great returns is because I buy growth stocks. The reason why I give back some, it is what it is size my positions. I hold on to them too long, and as it says in the front line, growth stocks fall like rocks. Your market approach must change with the cycle. If you think we are going higher, then you want to be buying stocks. If you think we're dropping, you want to be shorting stocks. And if you don't know, you want to raise cash, have smaller positions, and sell premium. I think I could argue each of those 3 points depending upon which market we're in. Tough market, much tougher than it was starting March 23rd last year. Now, here's some bullish stuff. A sea of green. This is taking the individual sectors, and the real estate, I think I've got more than what might be in the XLRE, but the others I took right out of HGSI. They'll probably need to update it eventually. And I do this because it gives me a snapshot real time of what's working. Like, for example, every material stock and every energy stock that make up the components of the ETF were up on Friday. The majority of financials, industrials, almost every consumer discretionary, technology, staples, even utilities, healthcare, and REITs were positive. The one group that didn't look so good were communications and social. And that's probably because a couple of ex-Tiger fund guys who have their own funds blew up. And one of them literally blew up their fund, which took down a lot of Chinese tech. The other had some pretty fierce margin calls. At least that's what the rumors are, that some of the weakness that we saw perhaps last week that pulled the Qs and the Russell down may have been artificially caused. Well, it was real, but it was caused by people blowing up their accounts. Let's take a look at major markets here. Let's see if I can get the right one. Click on this and make it maximize. So someday I should just kill these fibs, but these are the fibs off the last low. And as you could see, we have gone steadily up from the March 23rd lows, which would be the far left side. Here is the all-time high on the E-mini futures. Now, the S&Ps look a little bit different, and I think the S&P, you're going to see we went into high territory on Friday. These are the futures. You want to be bullish? I'll tell you why you can be bullish. Sideways move, essentially a sideways move since February, okay? Pull back to the 50 and failed, pull back to the 50 and held. That's kind of bullish. We've got a new John Person buy signal came in on Friday, closed near the high of the day. That's a very bullish candle. So if we're talking just the S&P 500, I could see why you might want to be bullish. All right, let's look at the Nasdaq Futures. Different picture. The highs back here in February has been in a downtrend since then, and I always struggle with drawing here because I don't use this tool for drawing. So I probably won't bother, but you can see you've got a descending trend line here. Now, if you want to be bearish, you got a nice whole failure here. We'll talk about blue ice whole failures later, but typically that's a bad sign, and you might expect it to come down and revisit the 200. That'll probably chop up pretty seriously your technology portfolio. That's the bearish comment. I want to be bullish. It's a bullish candle. You got a little bottoming tail. You got above the 17-day, and I think at least an assault on that 50 would not be unexpected. A break above that 50, the Nasdaq joins the party. But just look at the difference. Here, you got support at the 50 on the E-minis, and on the Nasdaq, you've got resistance at the 50. The YMs, here you go. Here's the all-time high print, which is about 10 days ago on the 18th. But look at the close. We got an all-time closing high. We sold off on this day. This was a topping candle, and this looks like a new run. New buy signal breaking up off the 17. And look at how this compares with the Nasdaq. Well above the 50. So the 50 is, my goodness, 32,958, if I can read, down to 31,497. It's 150 points away. Certainly don't want to go down, or excuse me, 1,500 points away. Don't want to go down and visit that, do we? Usually these person buy signals, you can see on these majors here, it was a nothing. But down here it worked. Here it was good, miss, good, good. And we've got a fresh one. Dow looks pretty damn good on the futures. How about the Russell? Here's the one in between. Now, on the cash markets with the IWM, it was 9 cents above the 50. So I'm going to say it closed at the 50. So you really got a line in the sand here. The good news is you're at the 50. Any move up probably is going to trigger a John Person buy signal. But you're still in a sell signal. Now, is this just a big move up, a flag, and a breakout of the flag? That would be the bullish context. The bearish context is we fail, and then we have a blue ice hole failure, more to follow. The VIX, it's pretty darn low. Hard to get excited about being long the VIX here. And we're starting to drop down, getting closer and closer to levels that we saw prior to the collapse a year ago. We're below the major moving averages. The VIX is in a sell, which is good for the markets. And the dollar has run up to the 200, sort of the opposite of a blue ice hole failure. Why? Because you broke above the 50 here, came down and retested it, had a little bit of loose there, and then broke above it and traveled all the way up to the 200. Flip that around, break down below the 50, fail it, and go down to the 200, and we'll talk more about blue ice hole failures to come. That was going to be my little teaching slide today. All right, not that one, but coming. All right, on the weeklies, really quickly, try not to screw this up. Got too many charts. On the weeklies, you can just see how far we've come off the low on each of them. S&P, you see it high on the week as the prior week. The high close was this week. Wow, 2174 to 3978. 1,500, that's a 70% on the S&Ps. That's a gigantic move. Nasdaq, you could see from touching the 200 here, March 23rd, sell signal up at the top, still has a ways to go to catch up. High on the Dow Futures was last week, but the high close was Friday. Here's the Russell, sort of in between the weakness of the Nasdaq and the strength of the S&P and the Dow. Here's the VIX and the dollar working its way back up. Now, I guess I probably should be careful what I introduce because I get lots of questions. But I started talking recently about the expected move. And I did get a bunch of questions how I used it. I think this week really gives you, I think, some, well, I'll show you how I use it. Here we are going back, I think it's supposed to be 3 months in full. All right, 3 months of the E-mini futures. When you see the dots, it usually means we've gone above or below. Those are big move weeks, volatile weeks, either to the upside or the downside. Where these come from, show you where they come from. All right, S&P 500. Let's look out 1 week. 28th will be, I guess it'll be the 5th. No, 28th. That's Monday. It'll be the 1st, which is Thursday. There's only 4 days. Here, it tells me what the expected move is over the next 4 days, right up here. Here's the implied volatility, which by itself doesn't mean much unless you know the historical volatility. And then this plus or minus 54 points. So there's about 110 range is the predicted range in the S&P 500. That's 54 up, 54 down. If we go back and pull up that chart, $38.91 to $40.33, 142. So pretty close, 54, right. $38.91, so it's 109, 142 points on the E-mini futures. If I was to go back here, oops. So it's a little bit more than that. I wonder if, let's see, what does it look like on the next day? I guess maybe it's looking at the 5th, which is the following Monday. And there's your plus or minus 70. The short week is probably throwing me off a little bit there. But let's go back and look at, but that's where it comes from. It's the implied volatility of the individual instrument, looking at historical, applied to pricing, and the options makers are predicting a move. So that means there's at least a 1 standard deviation likelihood that the stock prices are going to stay in between the green and the red. So let's look at what happened this week. On Friday here is the close the prior week. And this close, red candle, so closed here, became the center of this week. They applied the expected move range to the E-minis here. And you could see that the E-minis traded up to the top of the expected move. Now, if you hit the expected move on Monday, you probably, it doesn't mean you want to sell everything, but you got to be careful how much you're going to load up on the E-minis, because typically these are smart people. You have, here was an upside outperformance. Here was a downside outperformance. Here is in, within, pretty much within, within. So when you start getting out, that should tell you that that's an extended move one way or the other. So you traded up to the top, closed below the top. And then no surprise, we traded down the next day, open near the open on Thursday, traded down, touched the bottom of the expected move, and then Friday traded up and took out the expected move. So the way I look at the markets, if I was very short term, on Monday at the close, I probably am thinking of looking for plays the other way because I've already gone through the expected move. And then on Thursday, this is a signal telling me it might be time to come back in. And we ended up just going crazy in the last half hour, which we'll look at eventually. So Nasdaq Futures closed above, so outside, so a very big move. Excuse me, this is not on the S&P Futures here. And notice that this is where the open is projected, which is the center of next week's expected move, is where the market closed. If we look at the Nasdaq Futures, these have pretty much lived within it, going back 1, 2, 3, 4 weeks, and they kept trading up to the upper part as they did the prior week. Really, not bearish looking at all. You stayed above the midline. Pretty big sell-off on Wednesday, and again, a nice close on Friday. So nothing happening there. stayed within the move the last couple of weeks. I'm looking for big moves out. If we look at the Dow Futures, you had a big move to the upside a couple of weeks ago, and the last 2 weeks confined. Again, when you travel down here and hit the bottom and rebounded, might have been a signal of time to spend a little bit more in the market. The Russell, this one looks different, doesn't it? First of all, this one has red dots all over the place, which means it spent a lot of time above and below its expected move. So it's been extremely volatile. Look at what the Russell did. Here's where it opened on Monday, and it traded down hard. Got way below the expected move on Tuesday and Wednesday. Thursday took a dump and reversed. And Friday closed right up at the bottom of the expected move. So it closed right at where the market makers thought it would be. These determine the pricing of options, and their goal is to reduce their risk. So they're going to set these at an area where the odds are in their favor. So coming back here is not a surprise. But again, knowing what I know about expected moves, this candle here told me I'd rather be looking long than looking short. To show you how much volatility we've had in this instrument, above one, so we have 1 week where we stuck our neck. Here we stuck our neck. Here we stuck our neck. We've had moves outside the expected range. 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. That's a little bit nuts. Just calls out some of the volatility of the market. We can look at the VIX, which is trading in the lower part of its range, closing at the bottom of the expected move. And then the dollar, which is performing to the upside and closed above. So again, how do I use them? I look for things during the day or during the week where I get a move too much to the above or below, and then I look for a reversion to the mean. I'm sure there are better ways of looking at it that I don't know. Rates, let's take a look at what happened underneath the major indexes this week. 10-year and 30-year rates fell. You could see the little nubs down. That's good for tech. AD lines diverge. So what do I mean by that? Notice in white here on the large cap Russell 1000, higher highs and just a little bit of a turn up on the index. Compare that to the small stocks where we came down on both the white, which is the new high, new low, the AD line rather, and on the red, which is the index. If I look at the NYSE, you can sort of see a composite of that, where the NYSE AD line reduced its fall, but it's still falling, but the diamonds and the spiders are up, while the IWM is down. The Nasdaq, let's see, the Qs are the bluish, actually picked its head up a little bit this week. And then you could see TLT, the bonds, actually the index TLT turned up as rates dropped. Breadth, still strong. Stocks above the 200 is up here. Go back years. You get back to 2017, the last time we were at these levels. So when you're more extended than you have been for years, tells you got an extended market. And this is a long-term moving average. To me, that's a long-term extension. 40 days have come down. Now, the other thing to think about is if about 70% of the stocks are above the 200-day SMA and only about 55% are above the 40, that means most of the stocks, the price is below the 40 and above the 200. ICE holds failures typically the 50, but I think the same story holds, which is there's a lot of stocks that probably have some overhead supply and some risk. 3-month new high, new low has been all over the place. It ended up a little bit on the week in a range that's high, but not excessively high. So short term, extended, but not as extended as perhaps we are in the longer term time frame. Daily McClellan, higher highs, lower highs, lower highs. So we've got divergence. Remember, we look for extreme readings. We look for divergence, and we look for zero line rejects. We'll see if we break above the zero line here or if we get a reject, which will be bearish. Weekly McClellan, again, higher highs, and you just don't see it on the oscillator. nor the summation index, so that is concerning. Buckets, 2/3 of the stocks in the S&P 1500 are above the midline of their Bollinger Bands. That is bullish, not excessive. About 7.5% of stocks are above their Bollinger Bands. Bullish, not excessive. In the free zone, I am totally perplexed on the Hindenburg Omen. HGSI has shown probably 4 of them in the last 2 weeks. Hindenburg Omens occur at market tops. It's when the smart money is selling out and we, the dumber money are buying. It's volatility, it's new highs, it's new lows. I guess, I hope this is recording. I guess what I'd say about that is I'm going to err on the side of believing what I see on the HGSI because it hasn't let me down yet. And there has been periods of time when I don't see on the same. Now, obviously, it's got to be constituents that I'm looking at. I look at the all Nasdaq, all the NYSE. I look at the NYSE Common. And what's missing on my review is that I just don't see enough new lows. You're supposed to be both new highs and new lows growing 2.2%. So no Hindenburg here. There are Hindenburgs on the HGSI, and I'm going to pay attention to those. They haven't let me down in the past. And go back last year and watch my videos a week or two before the market tanked, and you'll see me saying, boy, we're seeing a lot of Hindenburgs. This market's going to go down. Market tone, bullish. Friday's close was so strong, and I'm looking at the Woody indicator, which is sort of the third bands in, all green as the big move in the market flipped us to a more bullish stance on both the major indices, and you'll see here on the sectors, all except for communications, which was probably blown up by those hedge funds. Market weakness. Let me bring this back and be a little bit more neutral about my exuberance. ERG report, earnings per share rank, relative strength rank, and group rank using the fundamentals in the market a week ago. Notice that everything is below zero. That means the market as a whole did not do well this past week. Not necessarily true on some of the indexes, just to let you know that. For example, the S&P was up 1.67. The IBD 50 was up 0.37. These are averages. I eliminate the tail. I eliminate the head because there's very few stocks here. And what I see is a trend towards underperformance by growth. This is probably week number 5 of that. EPS rank, higher the EPS rank, the worse performance, the higher the relative strength rank. So I know I had a crappy week. Now, it turns out Friday saved my week. It wasn't so crappy. But going into Friday, 3 o'clock, I was starting to feel some pain. Here is the S&P. In yellow are a number of IBD 50, weekend review, MarketSmith 250. The combo is just a bunch of IBD lists. And you could see that growth underperformed the S&P, and then I'm sort of mingled in here with the growth. Minus 1.4 here. It's not truly fair because I have a lot of protection on, but like I said, up until Friday, I was feeling some pain. Sector strength improving. Let's look at the sectors here in the Sager's wonderful Q Edge tool. 1 day performance, you could see a lot of green, only one negative sector, very few negative industries, 90% of stocks advanced. It didn't look like this at 3 o'clock. If I go back 5 days, you could see on the week, it was mixed. But 2 weeks ago, it was weak. So 10 days is weaker. Going out a month, we were pretty strong. If we look down here on 1 day performance, 10 out of 11 sectors are up. 2 days, 10 of 11. 5 days, 6 out of 11. And you can see over 10 days the other way. In blue, you can see over a month the strength in the market in utilities, materials. The laggard being communication services and their close brother, information technology, and healthcare, boy, especially biotech, has lagged. If we look at the close on Friday, 10 out of 11 sectors were positive. Information technology materials leading the way. And look at information technology really turned around and come back up. Materials have been strong for quite some time. And communication services and utilities are the laggards. If I look at what's in information technology and materials and I rank them, you could see steel was strong, as was aluminum. Semiconductors really popped up. And of the 147 groups, you could see these are the top groups in these two sectors, but they're also top groups in the market. When I looked at undervalued stocks using the Edge tool, these came up, and I could tell you that some of these charts actually look pretty good. Qorvo was in the IBD weekend magazine. Broadcom looks good. Qualcomm and Micron have pulled back a lot, but they look like they might be turning as well. So we'll look at some of those as we go forward. Canaries in the coal mine. I'd like to see the generals come back to the fight. Right now, the generals have turned hide and run away. And you could see there's just nothing going on here. Kind of looks worse than the Nasdaq or the Russell, where it wasn't even a move up on Friday, or much of a move up. It actually closed down on Friday, just a teeny bit. So the canaries are not doing well. This is where some of those communication sectors, Amazon was weak as well. If you are a growth stock investor and you wonder why you're doing poorly, this is a 50 FFTY. It's an Innovator IBD 50 Fund ETF. And you could see it's down 17% in 27 trading days. Imagine with a little leverage, you could be down 50% in that period of time. China tech wreck. You want the good news or you want the bad news? We're down substantially from a highs here of 108, 109, down to lows below 80. About a 30-point drop, or probably about 25, 27% drop. Kind of like, not quite double, but at least 1.5 times what we saw in the 50. This is what got hammered because of those funds blowing up this week. Archipelago and another one. If you own Baidu, if you own Tencent Music Entertainment, if you own Joy YY, if you own Auto Home, if you own GDS, you probably got hammered this week. This been a tough week for Chinese tech. Now, the good news. Green candle low at the high jump of 0, or minus 100 rather, with the new methodology. Usually a place to see a reversal. A bounce off the 200. So maybe we should be nibbling on this. I can't buy something that has 356,000 shares traded. I need something more liquid. But I wonder if the Baidus and some of the other Chinese tech might be appealing this week. Talk about appealing. We'll skip the side of the left. I'm looking at seasonality. I'm looking out 1 month. Here's up, here's down. I've ranked these by average return. Over the next month, these are years that are up, years that are down. This is the percentage of years that are up. You can see something like Kane Anderson Midstream Energy Fund's been up 10 years in a row with an average 10%. Well, that's pretty interesting. Here's Matador Resources over the next month has been up 9 out of 9 years, 100% with a average return of 19%. So you can see there's some strong seasonality here. Notice energy, energy, energy. Here's a nice retailer that's been hurt lately. Energy, 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 energy. Gaming, I have no idea. Energy, 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 energy. Small cap bulls. Gaming. A lot of energy stocks with positive seasonality right now. So I'd expect, because of that Suez disaster, for oil to go up a few more days. But boy, oh boy, this is a strong seasonality time for energy. What's not working? Notice bear, 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 short, 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 bear, short, 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 short. Bad seasonality for shorts, which means strong seasonality for long. So April's a good month in the market. You know what happens after April? So do we get a run up into April and then we sell off? That's sort of my thesis that I'm working on right now. So could we see 3, 4, 5, 6% move, which would be a strong month, and then a sell-off? I'm not expecting a 50% move from here. I'm not expecting a 30% move from here. I'm expecting a modest move over the next month, and then I'm probably going to think that sell in May and go away makes a lot of sense. Now, with the tax changes pushing, I don't have to write my check to May 15th. Now, let me say why I said that. I've already paid in 110% of what I paid last year, so I don't have much penalties by holding on to my cash. I wonder if that impacts on the sell in May. Probably does. Another big thing that's going to happen end of quarter is a lot of bonds may be purchased. Since bonds did so horrible in the quarter, one might expect to see bonds coming up and stocks going down. Since bonds have been pulling down tech, that could actually parenthetically, paradoxically, whatever the right pair of word is, be good for tech. Remember, Friday is a holiday, but you still get, as John Person likes to refer to, the monthly unemployment report. Numbers have been improving. The Fed is, keeps telling us they got our back. So it's a busy information week, even though it's a short holiday because of that. Earnings, nothing on Friday, and you could see here a lot of earnings. I'm looking for big companies that are going to move the market and impact on my portfolio. Chewy has been a big story. Here's Lululemon, or as I like to kid with my wife, Lululemon. If you own any of these, it's a big week for you. Micron, but not a really giant week. And my wife's yelling lemon. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Beware blue ice failures. I hope I'm not being prophetic here. So there used to be a website, which I'm not even sure exists anymore, called wallstreetteachers.com. The proprietor of that site was a guy named David S. Elliott. In Judaism, we have a word called mensch. David was a mensch. David would do webinars like this multiple nights a week at no charge. I met David Elliott. I was a traveling salesman. Yep. Yes, I am a doc, but I went into the business side of medicine, and a lot of my customers were both large practices in cancer medicine institutions and drug companies. So I was out in San Francisco visiting Genentech, staying at this lovely Embassy Suites. Not so lovely, actually. It's not as glorious being on the road as you think. Embassy Suites was right by the SFO, San Francisco Airport. I go in one day and I see free financial conference, David Elliott. I go, hey, I've got nothing to do tonight. My meeting's not till tomorrow. I'm going to go. And I sat through and I was just mesmerized. He is such a smart guy. And he has some videos out. A lot of things are available free on the web. He likes to talk about some of his favorite moving average patterns, MAPs. This is one. It's called a blue ice failure. If you think about it, if you grew up in the north like I did, and you're out walking on the ice, and you break through the ice and there's nobody around to pull you up, it's not a good thing because you're likely going to drop down to the bottom. And in life, you don't always bounce. Well, similar thing happens in stocks. A blue ice failure would be your stock or your index is doing fine, the 20s above the 50 SMA. You pull back to the 50 SMA and you bounce. All right, you pull back to the 50-day, you fail at the 20, fail above it, doesn't really matter. You come back and you don't bounce, you break through the 50. So you have broken through the blue ice. You climb back up to the top. and you can't get out because you're not where you fell through. There's no hole in the ice. What happens? You go down and you die. Blue ice hole failure is that failure to get back above the 50-day, and it typically results in a retest of that 200-day moving average. Now remember, where are most of the stocks in the market living today? Above the 200 and less than the 40, in this range here. Here is the Qs, 2000. A lot of people see some similarities between today and the 2000. Here is the Qs breaking down below the 50, struggling to get up, getting up for one day and breaking down, a blue ice failure. And what did they do? They came all the way down and revisited the 200-day SMA. Here are the Qs, 2004. Running up, bounces off free parking, the 50, bounces off free parking, and then they break through free parking, the 50-day. Went sideways. This looks a lot like today, folks. In here. Failed at the 50 and went down and tested the 200. Now, in both cases, time was your friend, and eventually the correction ended and the markets went higher. Where are we at today? Here are the Qs, broken down below the 50, have tried several times in here to get back above, failed here, multiple failures here, failed here, and now we're sitting right here. We better hope, if you're bullish, that we see a rally on Monday or Tuesday and very quickly take out that 50. Because right now, folks, we are in a blue ice failure pattern. Thoughts? We ripped higher in the last 30 minutes on Friday of all major indices, finishing higher on the day. Broad-based rally. Fed eased rules on the banks. They rallied. Inflation was tame. Market rallied. Supply concerned. Energy rallied. Divergence in the market as the S&P and Dow outperforming. Seasonality strong. I showed you that. I did some nibbling. I saw a huge number of bullish candidates, but so many of them are candidates for blue ice hole failures that I had to tell you what that was. And again, we got some new clean news flow this week. So let's take a look at the charts. I know I'm 42 minutes in, but I can promise you the first part is probably more important than the rest because it's all about the market. Let's talk about that last 30 minutes. So here are the major market ETFs, the spiders, the Qs, the diamonds, and the IWM. This is using some charts that are modified from Sagar and then some of my favorite HGSI related indicators. When I look at the spiders, here's your John Person buy signal. Here's ultimate support. We don't want to come back and touch it, but we've touched that trend line several times. We'll probably start to paint a trend line going up at 45 degrees sooner than later. Here's prior high resistance a couple days back. This is the cash markets. And this here is the upper boundary. I would expect to see more resistance there. Uptrend, above support, in a buy signal with some room to run. Let's look here at the diamonds. Uptrend, above support, getting close to resistance, but still a little bit of room to run. These red dots here, pink dots, these pluses, are Q signals of when we're getting extended. So we haven't seen them yet. The IWM pulled down to support, broke through it, got to earlier support, and now looks kind of chipper above the support line. What looks different? Look at the Qs. Qs are in a wedge, and they've been bouncing between the top and the bottom. And as I've shown my neighbor, until we break above that, you've got to be careful. Now, if I want to be bullish, it's a blue candle, big move, closed near the high. If I want to be bearish, it closed near the resistance line, and we still got work to do on the Nasdaq. Let's look at the last bar of the day. See what I mean about the last 30 minutes? Let's look at the last hour. closing right off the highs. But this bar, I mean, this bar is freaking nuts. Opened at 392. That was a 1% move and closed at 395.95. That is a very, very powerful bar. Remember, 3 points here are 30 futures points. Let's look at the futures. Let's look at the last hour. Massive moves, short term into resistance on all of them. So if you made money on Friday and you, like me, were feeling kind of crappy about your day, you forgot about the last 30 minutes, or you wanted to forget about it, you turn back on your computer, it was like, oh, that was a nice day. It was all the last 30 minutes, folks. Let's look very quickly. E-mini did get a buy signal on Friday, a green paint bar from Alexander Elder, which means I can be long or holding it. I shouldn't be going short. Still an uptrend on the weekly and the monthlies. Nowhere close on my high jump bar. The weekly bond goes green. This looks actually pretty good. Wouldn't surprise me to see it go higher. The Dow, similar story. Even got a laggards RSI signal, 83% on the high jump, so it's not excessive yet. Still below the envelope. Wouldn't be surprised to see it go higher. Now the Russell, blue, so it's not quite as strong. Still an uptrend on the weekly and the monthly, but has not given me a new buy signal on the daily. I think we just got to get above the yellow for that to happen. So questionable. And then Nasdaq, less than questionable. It was a green day, but it's also in a weekly sell, in a daily sell. So it'll be interesting to see what these indexes do. Let's take a look at HGSI. Up here, I'm looking at Major Markets Plus, and oops, daisy, I'll leave that where it sits. Go to top-down view. Show about 38, 36. Okay, do I not have the fangs in here? Hold on a second. Yep, I put them in there. All right. So first thing I want to do is look at, I just want to look right here, and let's look at percent index off the high. VIX is down 92% off its 52-week high, and the 52-week high was a year ago. Okay, 360 days. ARC Innovation ETF, its high was February 16, 2021, is down 28%. ARC Genomic Revolution, high was 210, it's down 26.5. ARC Next Gen Internet down 25.5. ARC FinTech down 22.5. ARC Autonomous Tech down 19.7. ARC Israel 19.7. So Kathy Wood is in a bear market. I mean, she's clearly has been the darling of the last run-up, has really outperformed. This is what happens with growth stocks. And, you know, she's in funds, ETFs, that she's got to stick to a theme. And those themes are down a lot. Most of us don't want to see our portfolio drop like that. If you're all in growth and you're not protecting and you've got too many positions, you could be down like that as well. If we look up at the top, the S&P 1500 is down a little bit from its high. As I said, we got close to the high, so the high was set on 318 10 days ago on the S&P 500. We're 0.5% off the all-time high. Remember, that would be trading high. On the NYSE, set on the 18th, we're less than 1% off that. S&P 100 set about a month ago, we're 1% off of that. Philadelphia, Russell 2000, we're about 6% off. 52-week high was set 13 days ago. So that was S&P 100, not Nasdaq 100. Nasdaq Composite, we're down 7.3%, 38 days from the high. So, you can see that the major indices have actually improved on how much off they are. Are we about to go out and set new highs nominally? I think that's got to be one of the theses, certainly not a guarantee. If I look at 2-day momentum, we can see, I don't want that, I want the top-down view. My bad. You can see, again, ranking where the strength was, transports, S&P 1500 industrials, S&P 500. The Nasdaq stuff is down in here. The IBD 50 is down number 20. Bunch of ARC stuff still down on the bottom. So buying growth works great, but as Ian used to say, they go up like rockets. They come down like rocks. So let's take a look here. S&P 500 rocketed up to 3 on this review. So here's the S&P 500. To the left would be the lows in March. Nice run up against a Fibonacci extension here. You know, yeah, we're higher highs, and look at this. This has got to be all-time, well, maybe not as high as this on the cash market here, back a little bit. But we're up near all-time highs. It's hard to be bearish at all-time highs, especially when you got the right formation of moving averages, a new buy signal, a mobile breakout, a kahuna. These are the Hindenburgs up here, 3, 4, 5 of them. That makes me a little bit concerned, but if I was a betting man, we got a little leg up before we collapse. This one looks pretty dang good if you're bullish. If I want to look at the Dow Jones Industrial, kind of looks like the S&P, and this one did set a new all-time closing high on Friday. That's a daily. Here's the weekly. You can see prior week had a higher high, but not closing high. Again, just like the S&P, super duper strong. I'll go look at the Nasdaq composite. There's your risk of ISO failure. You failed here, trying to get there again. This is a long distance. Just to give you an idea. From here to that low was about 10%. From where we are today to down there would be another 10%. That would hurt. Wouldn't kill, but it would hurt. You can see the weekly really going sideways over the last couple of weeks. Got to be nice to get above that 50 in the Nasdaq. Russell 2000. You can see it sitting right on the 50. So clearly for the small stocks, the Nasdaq stocks, the tech stocks, we're at an important position in this market. Semis really woke up this week. This is, man, if we can see this on the Nasdaq on Monday, I'd be very bullish. Broke above the 50, the new John Person buy signal, kahuna, mobile breakout from a squeeze. If that was a stock, we'd be looking to buy it. Funny, I have a lot of stocks that look like that this week. Biotech, not so exciting. Pulling back down to support. God, I'd like to be in biotech, but I'm not in it right now. I want to get back into it. Seasonality in biotech. The ASCO meeting, which is the National Cancer Meeting, is the first weekend in June. Abstracts, which are sort of small snippets of the data being presented, will come out mid-May. I've got abstracts I submitted as well. Those abstracts will move the market. Anticipation of those abstracts will move the market. And then the presentation of the final data set, not mine, of the overall in June will move the market. Biotech has a tendency to run up into May and June. So I'm being looking as an excuse to get into biotech. I already showed you the IBD 50, how weak it was. And again, so many of us, our portfolios probably mimic this. So we bounce, but we've got a long ways to go before we can be out of danger. The FANG stocks have been weak. You can see it here again. And I already showed you the ARK stocks, but let's just look at the ARK Innovation ETF. Yeah, at some point they're going to bounce, and at some point Kathy Wood is going to be vindicated. But let's just do this. Let's see if I can make this happen. Talked about the Chinese stocks. Unfortunately, let's see if I can change it to group. Yeah, thought I could get you a list of the components through here. Baidu. Is it a buying opportunity of a lifetime? It might be. Certainly looked good during the day on Friday. How about how to ruin a day? Imagine you have a big position in VIPs. Oops. Buying opportunity? I think so. Why? So let's be very clear when I say buying opportunities. These are stocks that have pulled down to the 200-day moving average. They blew up, probably related to hedge funds blowing up. I'm not saying they're great stocks. I'm not saying they're great companies. Sometimes you can take advantage of somebody's problems. All right, let's look at the dollar. Trying to get above the 200. Dollar strength, problematic for gold. And it's hard to get excited about gold down here. How about silver? And gold miners, I think, look a little bit better, but hard to get excited. Oil, kind of slow, boring uptrend. Just look at some of the, like the 3X energy. Here's the bears. Down, let's look at ERX then. ER. Yeah, it's hard to see it because there's so many reverse splits. How about Gush? Yeah, I think there's a story here, so let me tell you the story. Look at the prices here. How do you get prices that are this high on an ETF? You do reverse split after reverse split after reverse split after reverse split after reverse split. And those reverse splits ultimately, this is what they look like. I'm speechless. Interesting. All right, let's look at industry groups. All right, where are my industry groups? Come on. All right, there they are. This is what happens when you are playing with your screen resolution and have a bunch of things running at the same time, as you might notice on the bottom of my screen. All right, so we've got 174 groups. You want to see how we ended the week bullish? 2-day up, 87. 2-day down, 5. Agriculture, wealth, specialty pharma, healthcare, and consumer electronics. That's a pretty bullish picture. Looking at 5-day intermediate, 40 down, 63 up. So a little bit favorable on a longer time frame, but it's really short term that we're seeing a big move here. Typically, I look at the top 10 groups. I'll look at a couple. I know we're already at an hour. Right click on rail freight, Norfolk Southern. There's buyout in this group this week. Kansas City Southern got bought. So lower left, upper right, breaking out, pays a 1.4% dividend. Rails have been strong, for the year. CSX breaking out here. Sideways move really from November. Mobile breakouts from a squeeze. You got a new person buy signal. This looks interesting here. The question is how far are they going to run? It does have some earnings coming in. Revenue's kind of stable or flat is another word of that. Small dividend. Union Pacific broke out here. Two kahunas, mobile breakout from a squeeze. It's not a railroad guy. And here's the one that got bought. Canadian Southern gapped up here, being bought by, actually not Canadian Southern, Kansas City Southern being bought by Canadian National Railway. So railways looks interesting if you're into those kinds of things. In fact, I screwed up because I didn't rank by raw combo. So they're actually the 60th positive group. Good. I'm glad I didn't get all excited and gaga over them. Dumb. Cardinal sin. Ranked by raw combo. I mentioned semiconductors are looking chipper. Micron sitting on the 50. Mobile breakout. A kahuna in a squeeze. Green candle low. Great earnings per share growth. Under some demand. Micron looks interesting. Nvidia. It's down at the 200. Not as interesting to me. Good earnings per share growth, but a much higher multiple. Intel, they got some excitement because they're going to build some new plants. And their 7 nanometer, millimeter, whatever process. Kind of junky looking chart, but if you're into it, it's pulled back towards the 50. Texas Instruments, same thing, steady uptrend, sideways move and a breakout on Friday. Mobile breakout, weekly bongo, pocket pivot, kahunas, and John Person supported buy signal. Broadcom, I like this one more. Why? It's got earnings per share growth at or above the multiple. That's nice. Pays a dividend, sitting right on the 50. Lots of positive momentum. Told you semis looked interesting. Qualcomm, a little bit more risk because it's already pulled down to the 200, which means you could have ISO failure action at the 50. I would have absolutely no problem putting a stop below that 50, at 200 rather, and seeing if I could ride Qualcomm. Great earnings per share growth. Again, here's your chandelier stop. Somebody asked me how I use them. That might be where my buy point is, but it's far enough away. If I like this, I might nibble now. AMD has sort of been quiet after being just a great leader last year. Done nothing in months. NXP, gosh, I remember a couple of years back, somebody was going to buy it for $100 a share, and the deal fell through. Best thing ever happened to the stock. It's doubled since. Continue lower left right-hand corner. It's already started to move. Probably not the best setup. Analog Devices actually took out its chandelier stop, mobile breakout from a squeeze. Person buy, pocket pivot, kahuna. Makes money. Skyworks, about to take out its chandelier stop. What a great picture. Look at the earnings per share growth compared to the PE. Under demand, take out that chandelier stop. That might be one to nibble on. Marvell, a little bit below the 50. Microchip, another one. So clearly within the semiconductors devices, there's things to look at. Semiconductor manufacturing. Applied Materials, old name, breaking out, looks interesting. ASML looks awesome looking chart. It's just a $600 stock. Taiwan Semiconductors, is this a good buy? You go back 3 months, it was a darling. Maybe it is a good buy. Maybe it got hurt in the Chinese tech wreck. A little far down in the pattern, it's got a lot of, in my mind, it's got some overhead supply to work off. It's got chandelier stop up here, and then it's going to have to get through the 50. I'd probably pass. That's not to say it's not going to do really well. Magnachip, I don't know what happened there. Bible gap up here, so it's gone too far. I'm not going to look what happened. Lamb Research, love the chart. Don't love buying $600 stocks. KLA Tencor, same chart, $300 stock. Good earnings per share growth, broke out through the chandelier stop. And I want to just compare. I want to compare KLA Tencor versus Taiwan Semiconductor. Bottom fishers, this is a beautiful looking stock. You've got higher high and a higher low than it did over here. It's a little early to say it's a new trend. On the weekly, you got a big bottoming tail. But you've got all this people that bought here saying if only I can get out. So you got people probably selling. You got people up here who want to get out because it's a loser. So if it comes up, they might sell into it. You got to get above your chandelier stop. You got to get above your 50. You got to get above your 17-day moving average. If there's any strength in this market, all that will happen, and you'll be very happy with Taiwan Semiconductor. But if I look at KLA Tencor, you've already taken off your chandelier stop. You've already broken above your 200-day moving average. You got nobody up here looking to sell. You got no preform resistance or moving averages. What is the downside? You've already moved. You are 8% above the 50. If you set your moving average, your stop below the 50, it's still an 8% risk, 24 points or so. And on the Taiwan Semiconductor, I set my stop under this guy, and the low here was, say, 107.50. The high here is 116. Again, I'm risking $8 or $9, still a big risk. I think both are interesting, but they're different stories. Semiconductors look good. Renewable energy. And I look at this. I made money in it last year. I lost money in it this year. Still net positive. I'm out of it. This is a FOMO kills play. It's still got to get above the 50, above its chandelier. This might be a great time to buy. It had some upgrades come in last week. I'd rather see it start moving. Like First Solar. If I have to buy one, I'd rather buy First Solar. It's got some earnings. It's broken out above the 200, took out chandelier stop. Just like Taiwan Semiconductor, though, I have to be aware on all of these of overhead supply and people looking to get out. The next is the index, so we don't care about that. Jinx, Enphase, SunPower, Canadian Solar, DQ, Solar Edge, all the same story. The best of the best a year ago. Maybe this is the best today of this group, AEIS. Why? Because it's got earnings, good. It's got lots of revenue, good. If it takes out this chandelier stock and mobile breakup from a squeeze, new person buy, and a kahuna, at least this one has got a higher low and a higher high, and maybe it's resuming an uptrend. Beaten down industry group. Communication equipment. Interesting that this is here, considering the sectors. This has been a lagger. Cisco has already broken out and run. You're at the high jump. I would pass. Not to say it doesn't go higher. Apple. I still own some Apple. We're sort of caught in Never Land. I won't say to buy it here. Arista, expensive stock. I've missed out on this one. Look at the moves it's had. 200 up to 330 last year. It's breaking out here. Took out the 50. 2 kahunas in a row. Those who know me know that's something that I pay attention to. Earnings per share growth, less than half of the PE. That bothers me, but believe me, it doesn't mean the stock's not going to go higher. F5, another beautiful pattern breaking out. Sideways move in a base and a breakout on Friday. Exploration and production. Oil prices are pretty good. And we got a number of these stocks. These are all pullbacks, an uptrend. I'm looking for momentum to say buy it. EOG, great, phenomenal earnings per share growth. Look at how this went from $4 billion a quarter, 4.7 down to 1.1, and now it's back up to close to 3. Used to be a $136 stock, and now it's a $70 stock. So it's working its way back. I like this one. I love the pattern. Looks like a move up here. This would not be unreasonable. EQT, sideways move, breakout, mobile breakout from a squeeze. I think this is a shale provider in the Northeast, Midwest. Lots of kahunas. This one looks interesting. SM Energy, pullback. Looks like it wants to break out here. So there's a number of plays in energy. I've been playing Gush, although it doesn't look so good here because of the reverse splits. Other specific retailers, I'm not playing GameStop. It is crazy land. Enough said, everybody knows that story. Funko had a breakout here. What does Funko do? Pop culture consumer products company. Well, that just kills me. I'm not into pop culture at this point in my life. The Office Depot kind of looks like Taiwan Semiconductor, big pullback, 2 kahunas in a row, mobile breakout from a squeeze. But again, as I said before, lots of overhead supply and resistance here. Look at that coming in on earnings. Number 7, base metals. Can't forget the steel and aluminum. Here's Alcoa. It's had a huge run from 12 up to 32. How much further can it go? Revenues steady, earnings improving. Look at the earnings per share growth. It can go higher under major accumulation. Freeport-McMoRan pulled back to the 50. Below the 50, now retook the 50. I own some of this. It's okay, good earnings per share growth if it makes it. Here's another aluminum play. Banks. You know, uptrend, pullback, breaking out. Here's the chandelier stop up here. I think that's, I don't trust that. Let me just look at, hold on one second. Yep, the chandelier stop is up here. Yeah, it's because we broke through down there. So it still has a ways to go, but this one came up to the top. Multiple kahunas in a row. I always pay attention to that. A new person buy signal, mobile breakout from a squeeze. 3% dividend, Truist Financial Corp. A lot of these banks look interesting here. I'm getting tired, so I'm going to skip steel. Just like base metal, steel looks great. Cleveland Cliffs, I own a couple of these. Sitting on the 50 with a kahuna, looks interesting. A weekly high close doji the last couple of weeks. Good earnings per share growth under accumulation. These are too far down for my taste. Electric power. General Electric, I've just been ignoring this. I'll continue to ignore it. Generac, nice buying opportunity. We've been right on this before. And if you go back to the left, every time it hit the 50-day moving average, here's where my original buy was here. But every time it hits the 50-day moving average, it's been a buy. And you got a person buy and a kahuna. Obviously, you got a chandelier stop to get through. That's potential resistance. It's a $20 move from there. So buy a call and sell a call right above that. Take a little bit of money off Mr. Market's hands. Eaton looked interesting as well, breaking out above the 17 there. Kahuna mobile breakout from a squeeze. As you can see, there are a lot of good-looking stocks. That's the top 10 groups. Just want to look at steel builders for a second. U.S. Steel looks like it's running again. Look at the earnings per share growth. Look at the demand. But look at Nucor. Humdibbity. A steelmaker is a growth stock now. Look at the earnings per share growth. Is it gone too far? Anybody don't think this is going to $100 with that earnings per share growth? I don't have any. I might buy some even though it's extended. I'd rather buy it on a pullback. ArcelorMittal, Steel Dynamics going again. Steel is hot. Hot, 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 hot. Who would think anybody would ever say steel is hot? All right, let's go to the part where I show you my buy watch list. So how do I get this buy watch list? I have a set of smart groups that I love. And then there's some lists that I import or lists that I get, like the Perfect Speculator within HGSI. I download from a number of sources some great lists. I've got the key HGSI list, the Minervini scan, IBD 50, Market Smith 250, RS Line Blue Dot, and the weekly review. I've got some bearish ones that I download, looking for potential shorting stocks. And then I've got a bunch of others, Abe Screen and others that I get. I take all the bullish ones and I put them into my consolidated buy list. I put all the bearish ones and I put them into the weekend bears. I cannot remember when my consolidated buys had 1,959. I don't even have Mike Scott's list. It wasn't out yet. 1,959. My OmniTrader buys. It's an automated strategy I run. It usually gives me 5 to 10. It gave me 684. I don't. This is so bullish. It scares me. Trilogy buys. John Person's best scan that he has. Usually it's 25 at the most. 437. I could go on and on of all these scans that I use of how many stocks they had. Well, I take all those, I put it in the consolidated buys list. Then I put a filter. Now it's 5 and 500 to make it smaller. I get 1,160. I hand curate each of those, look at each one, and they get into my buy watch list. And then I categorize them by what type of buy. And people who've been with me know I really like pullbacks ready to run. So, I'll show you some more evidence of the bullishness. Another really cool scan is this Q Go with Flow. And what Go with Flow will pick up, it'll pick up stocks that are beginning a new uptrend. So here's a stock been in a downtrend, and the weekly still in a downtrend, but did a new buy signal and it turned blue, which is bullish. Still has to worry about some resistance here. But notice that the daily also turned blue off of support. This is Adobe. Amgen turned positive on the weekly 2 weeks ago, and we had another buy signal come in on Friday. Doesn't mean it's a good buy or not, right? But what it does is it screens stocks for uptrends. Now, here is AVGO coming into resistance. Again, 300 would be a lot. 708 bullish ones versus 89 bearish ones. If I look at pullbacks, another one of my favorite scans from Q, from Sagar, in TradeStation and in Metastock. If I look at long pullbacks, 10. Look at Skyworks. Pull back to support. And here it just, from pulling back, broke out, took out resistance. This stock, my target would be here, first target. About 195. And then my second target might be up here. This looks great. Pullbacks. Microsoft. Pullback on Microsoft. Not as great because I'm within this triangle. I'd like to break out of here. Cognizant Technology, I think will look good here. Broke out above resistance. So pullbacks here are a good scan. I had 18 to the long side. I didn't have any to the short side. Overwhelmingly bullish scans this week. Trilogy buys. So I showed you I had a lot of these. 437. Trilogy sells 9. Bull, bull, bull. Why? Of course everything's bullish. This is how we ended up on the last hour of the charts. So lots, is that a 1 hour wonder, or do we have a little run up? I think we have a little run up, but that's my guess, subject to change 9:30 in the morning. What else do I want to show you? I get a lot of questions about, do I have a scan to find pullbacks in an uptrend? I've constructed, which I haven't shared except to the John Person people, some warehouse views. And remember, when you're thinking that's not fair, I don't work for HGSI. None of you pay me anything, and I supported John's add-on, and I wanted to see more people get it, so I made these to support it. So here is a scan that found 602 stocks above $250, above the 200-day moving average, and within 2% from free parking. So these should all be stocks that are sitting near the 50-day moving average and above their 200. Now, want to see the filter I used? Here is the filter I used. You want to see, all right, so that's how I filtered them. You don't really need the combo. So if I look at Floor and Decor, it's above the 200, it's within 2% of the 50. Doesn't mean it's a candidate. These should all be above the 200 and within 2% of the 50. Now I did sub-scans. Here requires that you have the same uptrend, and you have to have at least a PPS buy, a mobile breakout, a kahuna, or a pocket pivot. So here I required you to have a momentum signal. So each of these should be stocks in an uptrend with a new momentum signal. Maxim, pullback, pocket pivot, kahuna, new person buy, mobile breakout from a squeeze, right below chandelier stop, has earnings per share growth. Well, that goes into my buy watch, doesn't it? Next one, form factor, pool, Microsoft, Freedom Holdings. Notice all of them are above the 200. Keysight looks interesting. Within 2% of the 50 and had to have a momentum buy signal. Now, if George is watching this, maybe he wants to redo my smart groups, and I'm happy to share with him. But I don't have time, and I don't do this as a business. I do this for fun. So I don't see me doing it on my own. Agilent, beautiful. Danaher, above the 200, within 2% of the 50, mobile breakout with a squeeze, person buy, pocket pivot, kahuna. So yes, I do have a scan for that. Now, if you're a toss person, there's this guy sending emails out named Steve Brooks. I'm not vouching for him at all. But I can tell you he's got this funny indicator called the GPS, and I had to buy it. And those that know me are saying, yeah, shocking alert. Now, I've looked at it. I can't even tell you what's in it. And even though you can open up the code and look at it, I have no idea what's in it. And he makes you sign paper that says you won't reproduce it. So don't ask me for it. But I can show you, I liked it enough that it made my daily scan and now include it. So if I look at these just for the hell of it, pull back in an uptrend with a move up, with a breakout. Pull back uptrend breakout. Pull back uptrend breakout. Pull back uptrend messy. Not yet. Pull back uptrend breakout. So actually this looks like it's finding my kind of stock. So I'll play more time and learn more about this. All right, I've talked so much. We're at an hour and 30 minutes. Geez, a pizza. I thought I was going to give you guys a break this weekend. Well, I'll give my paying customers the 1-minute version. That's a joke. I don't have paying customers. Don't want paying customers. Here's the stocks that made it to my buy watch list. Many of these we've seen already. Look at industry groups. Exploration and production. I really like Antero Resources here. Uptrend, sideways, breakout. Mobile breakout from a squeeze. 2 kahunas in a row. Great earnings per share growth under demand. Flow control equipment, several of them. Xylem looked interesting. Sideways move, breaking out. There is nothing over it. Nobody, very few people are sitting here, can't wait to sell. Home builders, life science equipment. I just showed you Danaher. Someday these things are going up. I like to see this one break up above the 50. PerkinElmer, similar story, but I'd probably have to buy it before then. Healthcare, insurance companies setting all-time highs. Humana breaking out. Lots of semiconductor devices. We've already looked at many of those. Semiconductor manufacturers. If you want a cheap one, ASE or ASX is the ticker. Uptrend, pullback, let it clear the chandelier, stop, mobile breakout from a squeeze, and a kahuna, beware, earnings are not far away. Ultra Clean Holdings, this was on Sagar's, undervalued, good earnings, nice pullback here and breaking out. UCTT. There's some steel producers we talked about. All right. Here are some of the ones I put in my pullbacks ready to run. Many of these you've already seen today. Let's see if there's anything perfect that I wanted to show you that I haven't shown you already. IQVIA looks expensive by fundamentals, but nice uptrend, pull back to the 50, and a breakout. Mobile breakout from a squeeze, a new weekly bongo, person buy, pocket pivots, and kahunas. Gotta like that chart. And then Abbott Laboratories, I'll leave you at this. This used to be Ian's Consistent Turtle. They spun off AbbVie, which took away a lot of their drug patent risk. Beautiful uptrend, pull back to the 50, set a buy stop right above the chandelier stop. Look at the earnings per share growth versus the PE. Teeny little dividend, mobile breakout from the squeeze, and a kahuna. On that note, I'm going to say goodbye. And just to reiterate, this was a crazy finish on Friday. I have no idea what the market's going to do. When I look at the sum of the evidence, I am leaning towards a little bit of a run. As I told my neighbor, a lot of time bull markets die after a nice spike. And maybe we're going to see that blow off top here. But, you know, if we get our 4 or 5%, I'm going to start selling into strength because, trust me, trust me, but verify, but trust me, you do not want to be the guy or girl that is sitting here with the margin calls when you're and selling down here. You want to be selling up here. Sell into strength. Let's see, we got a little bit of rally. And then I think it's time to take the summer off, because at some point we're going to have the sell in May and go away. And I think that could be this year. Just guessing. Again, this is all my pontificating and hypothesis and experience. Everything changes at 9:30 on Monday morning. Goodbye, everybody. Have a great Easter, great Passover, and thanks again for watching.